Okay, hi sir. Good afternoon. I don't know whether it's good afternoon or good evening. I'll be showing you how I did my assignment, how I did my exam. That's the one you sent on the emails, step by step. Uh, First, I did it on my exercise book. Uh, to put it on PPT, it wasn't that easy, but I hope you will understand. Yeah. Okay. Let's start. As you can see there, the question asks about decision making relevant cost illustration, whereby Anadel Limited has been asked to quote a price for one of contract company. Management accountant has asked for your advice on the relevant costs for the contract. The following are the information available. Whereby we have materials required 3,000 kg of material K, which is used regularly by the company in other production. Also, we have company has 2,000 kg of material K currently in stock, which had been purchased last month for a total cost of 19,600. Since then, price price per kilogram for material K has increased by 5%. Also, the contract also requires 200 kg of material L. There are 250 kg of L in stock, which are not required for normal production. This material originally cost 3,125 if not used on this contract. So the stock of material L will be sold for 11 per kg. And also we have labor. Labor contract requires 800 hours of skilled labor, whereby they are paid 9 to 50 per hour. There is a shortage of skilled labor, and all the available skilled labor is fully employed in the company in the manufacture of product P. The following information relates to product P. The following information which relates to product P. I had a hard time trying to put it in the PPT, but this far as I could. I hope you understand. And it's also there in the question, the one you sent us in the email. So, what are we supposed to do? The required steps. What are we supposed to do? First of all, A. Prepare calculation showing the total relevant cost for making decisions about the contract in respect of the following cost elements, whereby we have 1. Material K and L, 2. Skilled labor. B. Explain the concept of opportunity cost. C. Explain the concept of non-relevant cost in decision making for managerial accounting. I did a short brief summary before I start solving the question. This is a short brief summary whereby before I calculate, I have to write some few important notes aside. The contract requires 300 kgs of material K. Number 1. 2. The company has 2,000 kg of material K, in which was purchased last month the total cost of 19,600. Since then, the price per kilogram material was increased by 5%. The contract also requires 200 kg of material L, in which in stock they have 250 kg of material, in which the stock are not required. These 250 kgs are not required. So, as for normal production, they cost around $3,125 if not used in stock. Material L will be sold for $11 per kg. Also, labor. The contract requires 800 hours of skilled labor, whereby skilled labor is paid $9 to $50 per hour. Note that, you can see here, note that in the organization of the company, there is a shortage of what? Of labor. Solution. So here we are given to find the cost of material relative K and L, right? So here we start with K. The required is 300 kgs. We already have 2,000 kgs. We don't know the required is 3,000 kgs. We already have 2,000 kgs. Hence, the cost of 2,000 kgs, which is 19,600 is irrelevant. Cost per kg was 19,000, so we divide it by 200. So per kilogram would be to be $9.8, whereby it was gone to 5%. So the new cost, when we're trying to look for new cost, we take new cost 9.8 times 1.05, whereby it will be 10.9. Here the 5% it will be equals to 1.05. Here the 5%, this one, it will be equals to this. So the cost of the remaining 1000 kgs, we take the 1000 kgs times this amount here, it will be $10,990. So the amount of material for K, it will be 10,290. That's for K. For L, the required was 200 kg. We already have 250 kg, and hence it's not required to purchase. However, 200 kgs were sold instead of being used. It would earn company 11 per kg. Opportunity cost considered for decision making, it will be the 11 per kg times the 200. See here, the 11 per kg times this 200 here, whereby you get $2,200. That will be the relative cost of L. You can see K is 10,290, this K, and for L it will be 2,200. So for skilled, this is the last part. For skilled labor, first of all, we require 800 hours. If 800 hours were used, the company will not be able to produce. Hence, the contribution will be lost. 1 unit takes almost 4 hours of skilled labor. So that will be 38 divided by 9.5. So if we divide 38 divided by 9.5 per hour, hence in 800 hours, 200 units would have been produced. Total cost contribution would be 200 units times 40, whereby you get 8,000. Yeah. After that, the labor cost. When you're trying to solve for the labor cost, you take the 800 hours times 9.5 per hour. We times it, it will be 7,600. You take the 7,600, you divide, you plus it with the 8,000 here. So it will be 15,600. That's the total cost for labor. We're done the total cost for labor. So we're going to find three things: relative cost of L, relative cost of L and what? And K. Yeah, L. Relative cost of K, relative cost of L. We form them here, and also relative cost of labor, 15,600. So we are supposed to find three things. In the first, as you can see, the first question has three parts. This is the first part. We're done looking for the relative cost of each given cost, material K, material L. We found them. Now moving to the next part. Explain the concept of opportunity cost. What is opportunity cost? Opportunity cost is the profit lost when one alternative is selected over another. Is what? Is one alternative is when one alternative is selected over another. The concept is useful simply as a reminder to examine reasonable alternatives before making decisions. You understand here? It's a reminder before making reasonable decisions. We have to consider first before making the decision. For example, you have $1 million and choose to invest in a product line that will generate return of $5%. Return of 5%. That will be given, the 5% will be given according to the contract whereby you and the firm have been accept, whereby it will be given annually or monthly, it depends. So therefore, as opportunity cost approach, it is the cost of second best alternative, whereby the opportunity cost will determine the cost of leaving one option. Explain the concept of non-relevant cost in decision making. What do you understand by the meaning of relevant cost in decision making? Relevant cost in decision making, these are costs of managerial accounting term that describes the avoidable costs that are incurred only when making profit, making specific business decision. The concept is relevant cost is used to eliminate unnecessary data that would complicate the decision making. What are the unnecessary data? The factors influencing the making of the decision. So those factors are known as cost, insurance, and cost of removal. These are the factors that influence that may affect the managerial accounting. They are cost, insurance, and cost of removal. Question 2. The question 2 here deals with manufacturing organization, whereby we're supposed to know the single product which is sold for $60 per unit. And also the organization's monthly fixed cost are $54,000 and its contribution to sales ratio is 40%. This month it plans to manufacture and sell 4,000 units. What are we required to do? We're required to find the organization margin safety for the given month. What is the break-even point in a unit for this month? Before I solve these questions, this is the given summary. The important things you have to know and to be in your mind. First, the single product sold is $60 per unit. Totally monthly fixed costs are $54,000. Sales ratio by 40%. And also it plans to sell 4,000 units per given month. So first of all, you take the $60 per unit times the 40% to find the contribution margin before you solve for the break even or for the margin safety. Yeah, you times this one, the $60 per unit and the 40%, whereby you get 24. Here you can see you get 24. 2,400 divided by 100, it will be 24. So it will be 24 per unit. So the break even point here, it will be the fixed cost divided by the contribution margin per unit, whereby it will be 54,000 divided by 24, it will be 2,250. That's the break-even point. The margin of safety, total sales minus the break-even sales, whereby you take the 4,000 units to be produced. As you can see here, 4,000 units to be produced minus the amount you got here from the break-even point here. You minus it to be 1,750 units. So therefore, margin of safety in unit it will be this one, 1,750 units, and the break-even point it will be 2,250 units. So this is the final question. I hope you will understand. Thank you.